Market has certainly been volatile this year. In a down market, what are the 3 biggest mistakes that people make with their 401ks so that you can avoid that? I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, if you're working for an employer that has an employer-sponsored retirement plan, that 401k or 403b, or if it's a simple IRA, whatever, that account is your greatest, likely your greatest wealth building tool. Now, if you own a separate business, if you own some rentals or whatever, that has a lot of potential as well. But for the average individual, your workplace retirement plan is your greatest wealth building tool. It's critically important to your overall financial life, certainly your retirement goals and long-term plans. So make sure that you're taking advantage of it and avoiding some critical mistakes. Now, when your investments are going down, certainly you look at your 401k, see the balance is going down. It causes a lot of people to think, well, wait a second, I must be making a mistake. Investments are going down. And you know, as a long-term experienced investor, that no, markets go up, they go down. I can't guarantee anything as a financial advisor. You can rarely use the G word. However, history has proven that the market makes new highs, and then it falls from those highs, and then it goes on to make new highs sometime later. That's how investing works, and you've got to ride through those cycles, those ups and downs. And so during down markets, though, it's very common for people to make some significant mistakes in their 401k, and this can lead you from having that account reach its full potential in your financial life. So what are the big three mistakes that people make with their 401ks during down markets so you can avoid them? By far, the number one biggest mistake that people make with their 401ks in down markets is they stop contributing. They stop contributing. This is logical. Now think about this. You're contributing into your 401k. Let's say over the past month you contributed $1,000. You log into your account, you pull it up on your phone, you look at it, and it shows that you're down $2,000. Psychologically, you look and say, well, wait a second, I just lost my $1,000. I put $1,000 in, I've lost $2,000. Therefore, that money I contributed is gone. That's what you look at. That's what you think about when you open up your bank account and you look at your checking account and, oh, my balance was $3,000, now it's $1,000, that $2,000 is gone. That's what you think about. In your 401k and your investment account, that's different. Those balances are reflective of the prices of the shares. And therefore, when you log in and just look at the value of your account, you're looking at really the cumulative value of all those shares. Your $1,000 that you contributed in that example went in to buy more shares. The balance of shares that you own has increased. However, those shares are worth a little bit less. Therefore, people make the mistake, this critical mistake, when markets have been declining, to stop contributing to their 401k. It's a big problem. Number one is you stop making progress towards your retirement goal. That goal takes a lot of time and consistent contributions to achieve. And so therefore, one of the major reasons why this is an enormous mistake is you stop making progress towards that goal. Number two, by not contributing, you stop the ability of buying more shares at these lower prices. If you're going to contribute $1,000 and shares are worth $100 a share, you're buying 10 shares. But what if those shares all of a sudden become worth $50 a share? You're buying a lot more shares. Now you've bought more shares with your $1,000 just at a lower price. That helps you, that catapults, that whipsaws your growth, your potential for the future, because by continuing to contribute, you're buying more shares at lower prices. That helps your long-term performance. Now, stopping to contribute, you lose out on that ability. And then third, you lose out on the ability to get employer match dollars, extra dollars that can help fund your retirement. And so oftentimes when you're contributing to your 401k, that is happening automatic. And then emotionally you look and say, oh, I've lost money, I got to stop. And you forget that you're giving up some match contributions, some match dollars as well, some free money that can go towards your retirement. Those are the big reasons why stopping contributions during a down market to your 401k is one of the the biggest problems and biggest mistakes that you can make. The second biggest mistake that people make with their 401ks during down markets is maybe they keep contributing, but they switch those contributions into going into low risk. Now, if you're right on the heels of retirement or in certain situations, that may make sense, okay? Rarely does it, but it may make sense for you. That's why you need to be working with a CFP doing comprehensive financial planning to see if that's what makes sense. But as emotionally, as you're looking at your investments and the market's going down, one of the biggest mistakes you can make is then just say, you know, I'm done investing in the markets. I'll just invest in low risk. And while that's good that you're avoiding that first mistake, you're still contributing. That's good. You're getting your employer match. You're continuing to make progress towards your retirement. However, by not investing into those higher risk or those stock market investments, you're unable to take advantage of buying shares at those lower prices. You miss out on what's called dollar cost averaging, where again, you're contributing, let's say, that $1,000 each and every month. And when prices are temporarily low, that $1,000 is going to buy more shares. And when you do the math over time, that means you're buying more shares at lower prices, and that helps your return long term. By saying during down markets, no, I'm just going to save into the stable value or the short-term bond fund, something like that, you miss out on the ability to buy more shares when they're low. And my guess is once everything kind of smooths out in the stock market, you'll say, okay, well, I'm comfortable going back in and buying, investing those contributions into the stock market at higher prices, though. Emotionally, it'll feel better. But in reality, you're buying stocks at higher prices versus taking advantage of buying more shares when they're low. The way you make money in investing is buying low and selling high. And that doesn't mean you've got to time the market. I got to figure out a high point to sell at and a low point to buy it. No, you naturally do that when you're contributing on an ongoing basis to your 401k. So continue to contribute to those stock-based investments even during down markets. That will help you avoid that second mistake. And then the third mistake, I just mentioned it, and that is within your 401k, looking at your investments saying they keep going down, I'm getting out of the stock market completely. I'm getting out of the stock market completely. That's the third mistake that you need to avoid with your 401k. Emotionally, that might feel like the right thing to do. And even temporarily, that might look like the right thing to do. That might be the right thing to do. If you got scared with the jitters last fall of 2021, and you said, you know what, I'm moving to cash. By now, you're going to feel like a genius. Absolutely. But here's the thing. Here's the thing with getting completely out of stocks. You've got to be right twice. You've got to be right twice. And so therefore, you've got to get out before things drop, and then you've got to choose to get back in before things rebound. And that is statistically very, very hard to do, because if it's emotions, not research and analysis, if it's emotions that say, I'm getting uneasy here, let me get out, those emotions need to be the ones that say, you know what, I'm getting more comfortable, I'm going to get back in. And most times, pretty much all times, those emotions are the worst, the bleakest, the most negative at exactly the bottom, at the time when the stock market turns. And as the stock market starts rebounding, off of these lows, your emotions are going to tell you, yeah, it's coming back down. This isn't sustainable. And it goes really, really quick, and then all of a sudden you miss it. And now, it's very possible you could sell out at a high point, buy in at a low point. I'm not saying that it's impossible. It's very possible to do that. However, it's very difficult to do on an ongoing basis. Therefore, within your 401k, dollars you're not going to touch for a long period of time. During downturns in the markets, one of the most dangerous things and biggest mistakes you can make is just get out of stocks completely, because it's going to be hard for you to get back in. And get back in at a better price. History's proven just riding through those ups and downs in 401ks where you're not going to touch the money for a long time, you're not going to need the money for a long time, that's proven to be the better strategy. Still, work with your overall financial planner. I'm not saying that you shouldn't make any changes to your investments. You got to be careful about that, but work with your CFP. Maybe you were taking too much risk. Maybe you were taking too little risk. Maybe you're not diversified enough. But one of the big mistakes is getting completely out of stocks, because it's hard to then get back into stocks at some future time. So those are the big mistakes with your 401k in a down market. Work with your certified financial planner. Make sure that you're using that 401k, your greatest wealth building tool, to the maximum opportunity to improve your overall financial situation in all 6 areas of your financial life. That's why you got to work with a CFP, one that's doing comprehensive financial planning. If you don't have a CFP like that on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K. WiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.